With chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're a full-service financial advisory based out of Dover, Delaware, serving clients all across this great country. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come, trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Thursday, March 28th, 2024. Markets closing down a little early this week thanks to Good Friday. A little shout out to our CFO on her birthday. I think it's her 39th birthday again this year. So happy birthday to her. Some shout outs to folks that are always tracking us. You know, we see the likes on Facebook and whatnot. So a little shout out to Michelle and Terry, although Michelle's the one who listens, and shout out to Chip and Dan and all the folks. We just really appreciate it. So let's go ahead and jump into the numbers, tell you what is going on this week. Markets pressed onward and upward, up a little bit more this week. So Dow Jones up 0.8%. And that's good to see. A little bit of an outperformance here with the Dow. It's been lagging here so far year to date. So a little bit of movement there on the Dow. S&P 500 up 0.38%. The NASDAQ composite, which has been pretty hot here for over a year, down a little bit this week, down 0.3. But then here's what really is pretty exciting. The Russell Small Cap Index up 2.5% this week, up 2.5%. So we've been talking for a while now about the market's need to broaden out. Last year, a lot of the returns were driven by the big 7 stocks that everyone wants to focus on, things like Facebook and Amazon, Google, Microsoft, Apple, Tesla, and NVIDIA. That was really driving the market. Although I did make the case that there's a lot of other stocks that were doing well too, right? Because we own some, things like Rolls-Royce and AMD, et cetera. Most of the pundits out there want to say, oh, the market's driven all by 7 stocks. Okay, that's fine. They did carry a lot of the weight last year. In order to see things continue on in a healthy fashion, we've got to see more participation. We've got to see other areas of the S&P 500 kick into gear and start to perform. And we need to see other areas of the market in general, things like small caps, kick in and start to perform. Well, we are seeing it. We're really starting to see that. You look at the equal weight S&P 500 index, it was up 1.6% this week versus the S&P up 0.38. We're seeing things like energy kicking into gear, financials. And of course, we have money we're overweight significantly right now in financials. They were up 1.7% this week. Energy, we're a bit overweight there, up 2.2% this week. So I'm glad to see this. I'm glad to see these areas of the market really start to move. And then some of the areas that have been so strong, things like semiconductors down 1% this week. Technology down 0.78% this week. Communication services down 0.2%. So really seeing some broadening out. Now, we've seen some of this happen in fits and starts, right? We'll start to see it, and then it pulls back, and et cetera. So will it stick or not? I think it sticks. I think as you take a look at the economic data, which is kind of hanging in there, it's been mixed, but it's hanging in there. And you take a look at the market technicals, which we talked about a couple of weeks ago, things kind of got turned around there. Looked like we were headed for a correction and things reversed. I think this broadening out can continue. Looking at some other things, volatility index, it was down just a touch this week, down about 0.4%, down 0.38. The TLT, long-term bonds, up 0.68% this week. And then gold up 2.68%. Gold is really breaking out. I think we mentioned that a while back, that gold was looking like it was really starting to break out on the charts. Now, we don't have exposure directly to gold. And the reason why is that gold is dead money. If it's not going up, it's not doing anything for you. And I don't like that. I don't like dead money in the portfolio if we can help it. We like to see some interest, some dividends, some buybacks, something going on. So I tend to utilize gold miners when we want exposure to gold. We've got one in our models, Kinross Gold, paying a really nice dividend, doing a nice share buyback. And that's what I like about a miner. While you are waiting for gold to make its move, you're still getting paid. And then on top of that, when the metal does move, you tend to see an outsized move with the miners. So for example, gold is up 8.6% for the month. And then you look at Kinross Gold and it's up 25% for the month. So I like to see that. And I tell you what, gold's not the only thing breaking out right now. Copper is as well. We talked about that. We bought Freeport-McMoRan towards the end of last year because copper was looking pretty good on the charts, and it's really moving. Freeport-McMoRan's up 24% this month as well. So we're really seeing this big rally, this big bull market start to broaden out and capture more areas of the market, and we're happy to see that. I think that's healthy. I think that certainly suggests that there's certainly more room for this bull to run. As a matter of fact, I think there's a lot more room overall. On a technical basis, I think you're looking at 6,000, 6,100 on the S&P 500. I think we'll likely see that in 2025. We're at 5,200 right now. So I think we'll see 6,000 on the S&P before we'll see 4,000. Now, not 4,800, right? We could definitely get a correction, go from 5,200 down to 48, 4,700, something like that. That wouldn't surprise me in the least. But as far as getting down to 4,000, I think you'll see 6,000 first. So when we get a pullback, if and when that happens, which I do hope it happens, we've got some cash on hand. A couple of weeks ago, I think I mentioned the fact that the technicals really turned around on this market. It looked like we were heading right into a correction, and all of a sudden things stopped, they turned, and the market just kind of discounted and made those technicals obsolete moving forward. So we got new money that's coming in the door. We got that invested. So everyone's been participating. But we do have some cash in the models, and we want to continue to hang on to that because the market does look expensive. It does look stretched. It can get more expensive and it can get more stretched. Markets have a history of doing that. So, I'm not saying it's going to happen next week or the next month. As a matter of fact, April tends to be a pretty good month for the market, but we could see a summer swoon. We could see that old adage, sell in May and go away. Maybe that will hold true this year. The market has seemed to be pretty closely tied to traditional seasonal metrics leading into the Santa Claus rally last year and the first quarter this year and so forth. So we might see, a little bit of a slowdown here this summer when people go on vacation and traders stop trading and spend more time on the beach and things like that. Who knows? We got some cash on hand if it happens. And if it doesn't, we got plenty of exposure, especially to areas that look like they're really kicking into gear. So I think we're good either way, which is what I love, right? I love to have things set up where it doesn't really matter what direction things go. In the medium term, we're going to make money. And that's how we're set up at the moment. So hopefully we'll get a bull pullback. We can do some buying. I'm watching things right now. Got my eyes on a few things, just waiting for those right opportunities to come along. A couple other big things to talk about. Now, tomorrow, of course, the market's closed on Friday, but there is going to be a big piece of economic data coming out. That is another inflation number, the PCE number. And I will say this, the Fed has been doing some talking. Different Federal Reserve members have been out there talking. The latest is now some of the folks are floating the idea of no rate cuts this year. I'm not opposed to that. The economy looks pretty strong. A lot of times markets perform their very best during the pause period between the last rate hike and the first rate hike. Markets tend to do quite well. A lot of times when they're cutting rates, it's because they have to, because something's broken. So if they want to hold off, I think that's great. Coming into this year, when we did our 2024 outlook, when we sent out the newsletter for 2024, we said the market was expecting 6 rate cuts beginning in March. We said, forget about it. Not going to happen. Maybe 2 or 3, maybe towards the end of the year. Right now, it seems to be holding together. I'm surprised at how resilient the market has been in light of that, honestly, because the market usually gets upset when it doesn't get its way. But so far, it's been holding together quite well. And I think maybe some of that's because the economic data in some areas has started to turn. The leading economic indicator index finally turned positive after almost 2 years. The GDP numbers have been pretty good. We had a Chicago PMI manufacturing number today that was pretty lousy, but it's mixed, but it seems to be improving to some fashion. We need earnings to continue to climb. We'll see what happens there in this next quarter. So far, 16 companies have reported and included some first quarter numbers. Out of those 16, 15 have beat pretty well and raised guidance. If that's an indication for the next quarter, then we still may have some room to run in the short term as well. So that's what I have for you. I'm going to go ahead and wrap up. I do hope that you have a wonderful and awesome Easter. It is really the greatest holiday in the history of the universe, because without it, then this is all there is, folks, right? This would be it. And there's not a whole lot of joy in that. Although we have a good time here and there, I'm definitely looking for something much greater and much more awesome. So thank you, Jesus, for that. So look, between now and next year, as you're thinking about your future, your long-term goals, all the things you want to do with you and your money, maybe is retire a little early, maybe celebrate your 39th birthday again and again and again, take a trip, buy a second house, whatever the case may be. You know what your goals are. Don't just think about it. Think big, think big, and I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll-free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.